Okay, so we can see that this is ADR session, and we can see that ADR session is a little bit inside of previous RDR sessions, right? And we can see in that free YouTube video, the master talks about the 0.5 of the previous session being the validation point of what kind of model you have. We know that if this was going to be a squeeze model, it would look like this. We know that ADR would be located completely inside of previous RDR session, and then we would expect either an expansion downward, upwards, or a trumpet, right? And a trumpet meaning it takes out the highs and the lows of ADR, which is sitting inside of previous RDR session, right? All right, but we don't have that going on right now. So what we need to focus on is right now we know that RDR session, the midline is right here. And that's what the master says is the validation point of a downward expansion right now, right? So we don't expect to see this come up higher than that, right? And now let's look at lens data, right? So we can expect downward movement, expansion into RDR, right? Okay, so we're looking at the ES on lens data, looking at the retracement model. Medium retracement is 0.4, that's the halfway mark. So that means 50% of the retracements went to the right, 50% of the retracement went to the left, right? But what we see that's interesting that is very cautious is we've got this bucket right here, where this mode is, and this bucket right here, right? So from the 0.2 to the 0.7 is a high retracement area. So what we're going to do, we're going to go to the point, we're already in that area right now. We'll just mark a little box like that. Now let's scroll down. Oh yeah, and did we hit the 0.5? We hit the 0.5 already, so now we need to pay attention to this retracement, medium retracement after 0.5 standard deviation reached, right? We can see majority of the time, it never even made it back in the range, right? It made it from here to here. However, right? So we can say that where we currently are, there's a good probability of this being the drop off. So 0.3 to 0.4 being the drop off. So let's go to 0.3 to 0.4. So right here, right? So now let's incorporate the time into it. All right, we see that medium retracement time is at 5:30, which is right here. The mode is at between 4:15 and 4:30, and the drop off is at 4:30 to 4:45. So from 4:15 to 5:30 is the time that we expect the retracement. So from there to 5:30. So right there.
Make windows like this on your screen, guys. This is the way to do it. As students, you want to create, not just as students, as traders, you want to be taking the data and creating these windows of time and price. I've done it in a lot of my live streams over time, and you'll find there's a lot of confidence when you get that.
So we know that this is the mode, this blue line of the retracement time. We know that 5:30 is going to be the medium. So let's mark all 5:30. So the first thing you always do is you look at the possible model, right? That you have. Do you have a trumpet? Do you have a contraction trumpet? Or do you have an expanding, right? Upside or downside, right? And so we expect a downside expansion, right? Which means like we don't expect price to come back up here, right? So right now we're at the max, the 0.7, right? The 0.7, which when we looked at DrLens data, we saw we can expect to come to the 0.7, right? That's where the second mode bucket is, right? So now are we aligning with time? It is 4:50, 4:30, 4:15, 4:30, and then we have a drop off with retracement time. So we are, let's look at the extension time now.
Yeah, the max
Let me
retracements are going to fall off.
There we go. That's better. I had it too extended. It was throwing me off, right? So we know that the medium time is right here at 5:30. We know that the mode is right here at 45, right? And we know that the drop off time is at 4:30 to 4:15, right? So right now we're in the middle of it, but we can expect, and we're not going to just jump in the trade blindly, right? Unless you guys are just doing pure, you would have jumped in the trade blindly when it was at 4:15 at the mode, and that would have been right there at the bottom, right? Like, so does that make sense? Like, I'm not just going to jump in this profile, right? I'm definitely not going to jump in at 0.5 when I have a distribution and retracement like this, right? So now we're going to wait. This is what I'm talking about. We're going to put our buy stop or a sell stop, right? Right below that 5-minute low, right? And we're just going to leave this thing alone, right? Because it looks like the conditions are not favoring us. Anytime it's above that 0.5, like I'm very, very cautious about entering the confirmation, right? So now we can see, right? And so now what I want to go through you, like if it comes back, like I'll enter here, right below this low.
This is what we want to build to. Let me can I add something real quick, Matt?
Yeah, go for it, dude.
I mean, we want to build into being able to feel comfortable and confident enough within the data to understand where it's going. Our model is not taking trades within the range for probabilistic scenarios. Matt Mickey is showing you what we are considering an advanced trade because he has a very strong understanding of the data, right? You guys, we should be patiently waiting for price to return back to where? Have we hit half standard? Yes. We analyze the retracement data. Where are we looking to take the trade?
Real quick, I want to show something that's showing its hand right now. All right, so we retraced around the 0.9. I mean, we extended to the 0.5 to the 0.9. If we look at the how we target, right, we say 1.6, we subtract that by 2. So if we were to enter a trade, would be around 1.4. But look at this distribution right here. If you got two modes at the 0.5 to the 7, right? So to the 5 to the 7 right here, you have a pretty big distribution showing that this is, do you guys see how powerful this is? Right? So this could be the indication, like it rejected completely off of this mode, these two modes right here on the extension. So that could be telling us a clue, right? So we have to, in the back of our mind, we're thinking this might be the retracement and we might have just not got a trade today, which is perfectly fine, right? So now you got a couple of options, right? Like we all know the KM7 model, right? We can't wait to take a low risk trade right here where the entry would be here short and then the stop would be right here at the DR line, right? And then where we target, like I would target back to the 0.5 or back to this line or whatever, but I'd be very aggressive with the stop because this is an advanced KM7 model, right? So that's a option, or we can wait for this to trigger to the downside on the next 5-minute low, right? So let's talk about ICT, right? Like Kitt, when is his London silver bullet supposed to happen? Is it from 3 to 4?
3 to 4 o'clock is silver bullet.
Right? Do we have any fair value gaps? It looks like we missed this. So 3 to 4 o'clock.
That distribution leg to the almost to the half standard is where the inefficiency was printed, and there was a retracement back to 50% of the range. It appears, and then it distributed lower.
Yeah, so we missed it because this was the silver bullet right here. These three candles, it came back up, fed into it, and then distributed down, took out this low. So you missed that one. So this.
I just wanted to add quickly, like when you see Asia and London both take on such an expansive range, and if you're waking up to trade it, sometimes you just have to be patient enough.
Yeah. So right now,
say that I mean the move of the quote unquote morning was, you know, it kind of already happened. At least like on EU, GU, some of the forex pairs. If you look at the economic calendar, there was some catalyst. I wouldn't say it was a red folder news, but they did have a little bit of news this morning in the in the European. Captain Matt Mickey taking trade within the range.
So that was an example of a sell stop, right? That gets you entry. So that took out this previous 5-minute low. So that means momentum is going to be on my side, right?
For
I'm
sure.
saying that my stop's going to be, oh man, my alarm's going off. And what I'll target, I'll come over to the extension data and we can target the 1.4, but let's see, we're only at 58% of the range of the last 10-day average, right? So we've only moved 31 points when on average from high to low on the ES, we moved 53 points on the ES. So I don't think we moved too much, but I can say we can target a new low, which would be around 1.4. This is a very low probability trade because like above the 0.5. So I don't have good expectations, but from a medium retracement, this is a retirement setup. We all know what the retirement setup is. So yeah, I'm cool with taking this trade. I'm actually going to reduce my risk to right there, $100. So if it takes out this last 5-minute high, right, I'm out, right? I don't care. I know this is a low probability.
Yeah, and this is why we are focused on taking trades within the KM7 model. This is an advanced extrapolation of data, and Matt's showing you what it is.
Yeah, but I'm not gonna. I take my trades when I take my trades too. So like I'm telling you guys, low probability retirement setup, and I wouldn't recommend it if I was you guys. I would wait to get below this 0.5 or try to catch the KM model if it does come back down here.
Well, we do want to trade our model, but at the same time, we want to really learn how to comfortably and confidently read the data.
So look at this KM model in the. Well, you guys didn't have it. Never mind.
What's that? I mean, check out NQ, bro. I mean, NQ. There's a couple. I've got NQ up on my screen, but I've also projected price from the central bank dealers range.
Ooh, nice. Look at this.
Yeah, that's why I wanted you to look at it.
I take a really sick. I take this short right here from the ES, like right here, and I wrote it down to here, which had some clusters and stuff.
It's beautiful.
All right, let's look at true short. When do we confirm? That's right.
You guys can see Captain Matt Mickey's screen. My screen is running tandem. We're recording Matt Mickey's screen, and but you'll see on my trading view where I've projected the central bank dealers range to a specific level, and then we extended just past that level perfectly, which is for me a really, really good projection upward. So this W pattern that you would see, I think I'm on a 1-minute candle. But the W pattern that you see extending past the 4 standards, that's a really good sign for you to anticipate a low and or reversal back into the range. And then there's going to be a lot of these if-then statements to see where we go. The 50% of the flout, which is going to be right around the 50% of the Asian range, which is our DR level. You can see very clearly the central bank dealers range and the time versus Asia versus our ADR, and where we've stayed below the 50% of that for, as Matt Mickey was describing, an expansion downward. So we would like to see that. And if I go to a slightly higher time frame, if you look at Thursday's price last week, we really priced lower.
Yeah. So real quick,
go ahead, buddy. Go ahead. I just wanted to add that quickly, and go ahead.
For a lot of you guys got to realize, like, the simplest way to get your daily bias is off of that midnight candle price, right? ICT says it all the time: midnight price, right? You can see clear rejection. It's like right now it's swiping back and forth, and you guys know when I say it doesn't give you the obvious, then you leave it alone, right? Step away from the screen. Right here is swiping, right? But then we get clear rejection from that midnight price right here, and to the tick right there off the midnight low, right? So when we come into our charts first thing in the morning, we can see that where's the Judas at for the daily candle based off that midnight price? It went all the way back to the 0.5, the Judas of the ADR, and it decided to come lower. So we can think in the back of our mind, our daily candle, right, would look like this right now. And since we know that we're 40% of the average daily range is left is still print, right? So like the average last 10 days, right? We can tell that right now it's not like if I wanted to take this KM7 model that just hit right here, like I could have confidence because I know that we still have 40%. So 269, we're at 160 points on the NQ. The last 10 days, the average range from high to low was 269, right? So we can accurately take confidently just off of this model right here. When it comes back and test this DR line, we can take that short with confidence, knowing that there's about 40% plus this left on the battlefield to us to capture, right? So we can say we can take this short and expect it to come down. Let's measure it real quick. We said 160, so or 269. Where are the points at? I'll just do it like this then. That's still not right. From there. So what you do is you just measure around 269 points on the from the ADR all the way to down, and that will give you a pretty accurate target based off of other complexes where you would target when it comes to this, right? Does that make sense? You guys see how I just choose the midnight price and the high so far, following the Judas off of that midnight to see where we're going, and then it gives me, and then I just choose like DR data, like so for retracement value on the NQ right here, the 0.5 to the 0.4, medium retracement value after the 0.5 standard deviation, 5 to 0.4, right? So we know like I can take this KM model or I can just use basic DrLens data, 0.5 to 0.4 right here, right?
We'd want to ensure all the retracement values are exhausted, but I mean, it's a trigger. So if you're willing, to mess around and find out, that's going to be based on your discretion. But what we really want to do is analyze the data because we haven't had any retracement values back into the range outside of the one standard extension. It's been pretty much a free fall expansion downward. So we would really want to be looking at these retracement times. If I look at the data just quickly, the bars seem to be going up on the extension side and seem to be going down on the retracement side until the very end. So just visually looking at and extrapolating the information, for me, there would be a lot of if-then statements. I would not be pressing a button. I feel like a lot of anytime I see expansion that quickly, I would be expecting a little more of a whipsaw kind of movement, and for us to try to come back within the range to consolidate a bit. I mean, price kind of took off without us this morning, and that happens. So I'm far more interested in really trying to look at the information and anticipate what price is going to do, which is why you see me have projection fibs on my chart and why I'm trying to throw price, or I'm trying to project where I believe and throw price on the screen where I think it's going to go. And I do that with fibs, and then I utilize data. And the stronger that you get at both of those, then the better you're going to get within your trades. Go ahead, buddy.
One thing
by the way, I love what you're doing today, Matt. It's so awesome.
Thanks, dude. One thing that we can do, like if we are unsure about this trade, one thing we can do is we can measure the probability, right? How do we do that? Right? We take right here from where we are, when we think about entering, and we go, We add them all up. 11, 8, so that's 19. 19 plus 8 is 27. 27 plus 6 is 33. 34, 35, 36, 37, 38. So we divide 38 divided by the total number, 168. 168. We have a 22% chance that this holds and goes lower based off of the data, right? So now we know that so now we look at this, the 0.5 to the 0.4, like this bucket, right? So we know that's the halfway mark is right here and the mode is right here. So this gives this area more probability than this KM7, right? So let's divide that. So there's 168 samples in this. 168 divided by 2, because we know we're at the halfway mark because this is where the medium is. So that's 84. So now what's 84 divided by the sample? 168. There's a 50%, which you could have done in your head. This is a 22% probability that we head lower. This is a 50% probability that we head lower, right? If the medium was closer to here and the mode was closer to this line right here, I would take this short with high confidence because the probabilities would be around 60, 70, 80%, right? But right now, this KM7 trade only has a 22% chance of holding and going lower, right? Compare where if we use just DrLens data, it has a higher probability of holding this weight. Does that make sense to everybody? Maybe that was too advanced. But we're talking percentile. Think about like when your kid goes to the doctors, right? And they say they're 1 year old and they're like, your kid falls within the 90 percentile of the average kid, right? That's all we're doing. We're doing the same thing that doctors do with kids and measuring if they're healthy or not, but with how healthy is our entry point. Does that make sense to you guys? What do they talk in here? Like, do they just jump on the mic, kid, or do they just like have a little chat room?
Hey, Mickey.
Yo, what's up? Who's this?
Meditative investor.
Hey, what's up, brother? How you been?
I've been good, man. Been busy, but I've been good. Yeah, it's all making sense, man. It's all making sense.
All right. Sounds good. So now we know that the market's not going to show its hand easy like we want it. It already showed its hand with the silver bullet here, right? It's already showed its hand this right here, right? It confirmed right here. If it come back up right after the confirmation candle, we would have a high probability KM7, right? If the mode in the medium was closer to the KM7 line, we would have a more high probability. But right now, we know that the probability is only 22%. You can take this trade, but I definitely wouldn't be sizing correctly, right? I would be like, I would use my little stop entry, right, to get momentum on my side, right? And I would do everything I could to make sure that I'm not risking too much if I was to take this current KM7 model because everything's going against it. Besides, yeah, the model showed up, right? But look, just even the extension data on the NQ, right? Like we've already hit all 3 buckets of the extension, right? 1, 2, we've already hit that. And all the way to the 1.3, right? Like we've hit it, the extension for the NQ. So taking a short right now is not a high probability trade. Right now is the time to sit on your fucking hands and just let it play out and come back in the New York session. If I was to take a short, I would definitely wait to the 0.4 to the 0.5. Now let's look at our time zones. 4:15 is the mode. 4:15 to 4:45 is the mode. Guess what? We're already at 4:15 for the retracement, all the way to what time? We said 4:15 to 4:45. We already hit that, right? Like it didn't work out, right? So right now is honestly a time to sit on your hands, let it play out. What do you think about it, kid? It's only going to give you more premium selling area, right? If we take the Judas or we take midnight price and swing it down, like this is going to be in the premium area, right? And you want to sell from the premium. You don't want to sell from discounted areas, especially in low probability areas like this. That's just basic ICT. That's basic any kind of structure. So what do? We go to the other 18. We go to the other 18 future Forex accounts that we can go, assets that we can go to and see if there's a better play over there, right? We don't have to stick to the NQ. We don't have to stick to the ES, right? Go to Euro USD, go to the future contracts and check out the same thing. Let's see if we have a more higher probability play there. So for me, Kitt, I am saying there is no trade. Even though it looks juicy and it looks like one we want to get into, but and it might work, right? That's the thing about being a trader, right? You got to be able to make them discretionary decisions in the moment, but you do everything you can to get it on your side.
Hey, Mickey.
Yo,
From the Tuesdays that I've back tested in the ODR session, where the confirmation candle is between 4 and 4:30, a lot of my entry candles are after 6:45. Most of them are after 6:45. Something that I've noticed just with the Tuesdays that I've tested in the ODR session. And when I say entry candle, that entry candle is the KM7 model at the DR. My
that's a good
stop.
point. Listen, like if you guys have your chart books made, like I tell you, do chart books by day a week. We can easily see. Like, don't ignore the lens data over here because this is all RDR lens data. But we can just come in here. We can see. All right, so 6 o'clock. The move doesn't really happen until 6 o'clock, right? Why is 6 o'clock important? Look, another one. 6 o'clock. Why is 6 o'clock important from a time perspective? Can anybody tell me?
Yeah, it's a new 4-hour candle.
It's a new 4 hour candle, a new 1 hour candle, new 30-minute candle, a new 5-minute candle. You know what I'm saying?
90-minute cycle.
It's part of the new 90-minute cycle. So this is one of those days where we know we're not going to get a early entry onto that. It's probably best to wait for the macro from 550 to 610 to find an entry on that.
And that in itself, like the previous me without the data, probably would have taken that trade at, let's see, when did it come back? At 5 o'clock, where that 5 o'clock candle right there. I probably would have took it just to mess around and find out, right? But now I have a little bit more data.
See, this is why it's cool to have chart books, right? Because you can see how that 6 o'clock price plays out. We wanted this, like if you look on my screen, this is all the Tuesdays ever happened, right? This is even in 2018, right? We wanted this move right here, right? This came 7, but it's not showing it to us, right? So we might have missed it, right? And that's okay, right? Because we know we just looking at chart books, we wait for the 6 o'clock, but while we're waiting, let's look at how Tuesday played out historically with our chart books. Like, what did New York, what did ODR and ADR do that predicted what RDR is going to do, you know?
It's good stuff. It's good stuff.
So a lot of downward expansions on the Tuesday. Like, where are we?
which was I think, I mean, at least for me, it was clearly anticipated. But the move, regardless of which chart you're looking at, if it's on the indexes or if it's like euro dollar or the pound dollar, if a move happens, if there's that much expansion before you enter into the charts, it's one of those days where you know where it's a good day to analyze and to try to predict where price is going to go within reading it versus trying to click a button.
Yeah.
You know, and one thing that I highly encourage and we will be teaching here is where and how you want to key off of like the W pattern of this retracement. And depending on the chart, we've been analyzing NQ. I like to project price off of the central bank dealers range. So with the ICT everything indicator, you can clearly see what that time frame is. And you can also project the high and the low of when that price actually occurs. So we're looking at the price action leading up to the ADR, and we're watching it form, and then it leads. And very commonly, you're going to expect expansions, retracements, consolidations, and reversals. and really understanding trade plans and trade ideas based off of which move you're in. We like trading, we prefer trading expansions. And if we look at specific 90-minute cycles, then you could start to look at and anticipate when you're going to be getting a high probability move. I see a fair value gap at 330 on NQ that is still unmitigated. And that's at the top level of my projection of 4 standard deviations back within the range. So as much as I would be interested, or we talk about the KM7 model, one of the main rules within the KM7 model is analyzing your retracement values. So
And if
what
you look
makes
at
it interesting is, again, where and how we expanded 4 standard deviations from the open price of 6 p.m. and price took off. It took off and it left Asia rapidly. And this was an aggressive move downward. So
look at
go
this,
ahead.
kid. Look at this, kid. Like a simple AMD, right? Like we see it Sunday to Monday, right? Was accumulation. We manipulate it higher. We distribute it. And then leg 1 distribution happened. Leg 2 distribution happened during this move. So now, like everything in the market's telling you to sit on your hands, right? Because you already missed the move. And that's okay. Because saved R is better than lost R, right? But yeah, look at this flout and the standard deviations, like 2 a tick, hit it, right? So now we can expect a reversal, right? So now we've got enough data to just look at where we are on the battlefield, right? Midnight prices here, right? ADR and ODR like are supported in a shelf based off their DR and IDR line locations, right? So they're synced right here, right? So now we can just look in our chart books and see when that happens every Tuesday, what did it do, right? You can just, okay, so for, right, here's a good example. The ADR IDR lines and the ODR IDR high lines supported. And what did we get? We got a reversal. And then we just go do that over and over again. These ones, they were not, well, these ones are supported, but it hit the T.5, which is the second leg of distribution on an AMD cycle, and it reversed, right? Hopefully that makes sense. We're throwing a lot of different factors. We probably should rein it in, Kit. I probably should.
I think this is good. I think these are all building a playbook, looking at not just data, looking at historical data. All of us are here to become professional decision makers. And when you can utilize statistics, historical data, and pattern recognition, I think you'll find that your decision making will become better. So
look, this is a good thing for you guys to understand. Like if ADR is inside of previous RDR, we are now in this contraction model, right? And so what we can expect is a trumpet, right? And here's a perfect example of it. It's trumpeting higher. It's trumpeting higher, taking out higher time frame. I bet you if I put, previous days on this, like it's taking out some kind of PD array, right? And then it does a complete reversal, right? Like break a structure right here, return to fair value gap. And like it was all determined based off this ADR, right? If we put the float on here, we did the standard deviations, right? Right. I guarantee based off of this move in the RDR into the ADR, right? 2 standard deviations up, it would be right in this area. And that would have called a New York reversal, right? But all I want to point out is like this is what you want to see using lens, right? Because it's very predictable when ADR is inside of the open and close price of the previous RDR cycle, we can expect a trumpet in reverse, which is all it is taking out the high and then going for the low. And we can expect false days or a very powerful move like this. Probably not this powerful. This is definitely news driven. This is a news driven day of some sort, but same concept, right? Look at this RDR, previous day RDR is here. We have ADR all the way up here, right? So we're expanding, we're not contracting, right? Here's one where the ADR in the IDR cycle, ADR, IDR lines, and the ODR, IDR lines are shelving, right? And it gives us a chop day on Tuesday, right?
Any questions? I'd like to open up the floor to ask questions. I think Matt has given you guys a master class today on looking at data and historical data and the importance of not only collecting this information, but being able to have it at your fingertips to be making, again,
I have a question.
Financial decisions. Go ahead.
Matt, if you make your chart book and you look at the previous DR session, how many DR sessions backwards can be relevant?
So for me personally, like I like to have it all because like from 2000,
Yeah.
I used the last 5 years, but I've mainly focused on the last 90 days, right? 90
No.
days worth of trading.
No, but I mean, when you look at, like, say you have the NQ, I'm running out of battery because we have load shedding. So if I fall out, I'm sorry. But like, say you have a chart for NQ 2018 for a specific 5 September, and then you're looking at it, and do you go back specific
Okay,
amount
so
of DR?
I think you need to listen. Like I collect 5 years worth of data because whenever you're collecting a data set, whenever you're testing something, you have to have a realistic number to go off it, right? And that's just doing back testing. That's just finding my edge, my expectancy ratio, where my stop should be located based off of the model I'm back testing. Now, when it comes to preparation drills for what I'm about to trade that model, right? Because there's a crawl, walk, run phase. There's a learning phase, there's a testing phase, and there's a trading phase, right? When I'm in the testing phase, I'm testing 5 years worth of data on that model, on an Excel sheet, whatever, right? I'm back testing it and then I'm forward testing it, right? But when I go into the trading phase, all I care about is the last 90 days of Tuesdays, right? Because I know I'm trying to capture like this is the preparation drills that I do, right? Before I trade the day, right? I'm going the last 90 days worth of Tuesdays and seeing what the current, like what the playbook is, right? So it's like if we play football, right? And like I'm not gonna watch 5 years and I'm going against, the Chicago Bears, right? I'm not gonna watch 5 years worth of Chicago Bears. But as a manager of that team, I'm gonna watch 5 years worth of Chicago Bears to see what kind of like are they defensive, like what kind of plays is their business aligned around. But when it comes to my players are gonna watch the last season's worth of games against the Chicago Bears to, understand what their current season, how they're playing, what kind of formations they're doing, what kind of plays they're doing, what they're getting good at, does that make sense? So that's all you're doing.
Yeah, but
right?
no, I understand that, but I mean, like for now, we're looking at the ADR, the previous ADR. But do you look at maybe 2 days ADR back for now at this moment when you're just looking at these?
Which one for right now, and the kind of traders you guys want to be as intraday traders, right? So we haven't even started talking about weekly profiles. When I bring out the weekly profiles, start teaching that, right? My charts will be on a 30-minute candlestick, and we'll be back testing how to pick up trends on the weekly profile, and that's more so for the one shot, one kills for the weekly. Does that make sense? That's when I incorporate other sessions.
Because I'm sort of like followed your advice and making these chart books, but then I'm also looking at, and then I noticed like sometimes I have to go back to really a few days and sometimes a week backwards for relevant IDR or DR levels which are relevant. But I think that's a little bit too advanced, but I just was curious if that is something for we'll get to. But I just noticed that sometimes like, hey, that's weird. I think that those levels are more relevant now, but they're further back than one day.
All right, let's see. Yeah, got it. So
let me build on that real quick. If we look at the central bank dealers range and the flout are important, and we want to be looking at 3 days back, and that's our short term. And then our intermediate term is up to 3 weeks back. So, and then,
Okay.
and we're basing this off of IPTA. So there's 20, 40, and 60 days. So as intraday traders and key levels that we're looking at short-term levels, we're looking at intermediate term levels, or we're looking at long-term levels. And within those ideas, we're gonna try and find where and how price is reacting to what it's reacting to. So on a higher time frame, for example, where are we in relationship to previous higher time frame candles with their close price, with their structure, with their break of structure? And that might not be as easily seen on a 5-minute candle. So zooming out to an hour, to a 4-hour, to a daily, to a weekly, within an analysis that we're doing now, it is going to help you determine whether we're in short-term levels, intermediate term levels, or long-term levels for trade plans.
Hey, Kitt, real quick.
So
Guys,
I think,
right now,
can I ask one more thing? Can I just ask one more thing? Is it maybe better to also have like an analysis on a higher time? Because I'm doing it on 5 minutes, but it gets really cropped up. But I think now Kitt answered my question. It might be better also to make a higher time frame, like a chart book or something that gives you a bigger level than with the DR boxes. Or am I incorrect?
No, you can't be correct. Listen, like I said, there's a crawl, walk, run phase. At all times, I am trading a model that has made it through the testing and the learning phase. I am testing a model that has made it through the learning phase, and I'm learning a new model, right? So I'm always, and every quarter I switch it up, right? Real quick, we are in where time and price meets, right? So right now, we know based off of historical data and aligning historical data with live price action, we're at an area or if we were to take a short, we could feel comfortable taking this, but where do we place our stop where the edge is no longer valid? Right above the 0.5, right? And then let's see what the probability of this is. We've hit the 0.5 standard deviation to the downside, so we come over to the medium retracement after 5 standard deviations, right? We add all these up, we divide it, and we figure out what our probability if we were to take this trade. Before it was 22% when we were going to take this IDR or this KM7 model, right? I've already done the math for you. It's 83 divided by 148. And now we are at a 56 probability that this will hold, right? So remember, there's only 2 trades left that we can use lens data or the KM7. And this is one of the areas where we said we could take a trade. Our stop would go right above the 0.5 and we just target, the 0.5 down here or the 1, right? And if that would be a 6-hour trade, right? Or we can just wait until we get all the way back up here, right? If you want to take this trade, but right now, that's for you guys to make that decision, but this is just the time and price, right? So we can wait for time to run out, which this red box is based off of the historical retracement times, right? So we know we're getting we're coming up on the medium retracement time. So 50% of the retracement value we're coming up on that right now, right? So you can wait until 5:45, and then at 5:45:05, you can just enter a short. Could do it that way, but that's the way.
That I just want to add what we're focused on. This is I would say this is advanced right now.
Yeah,
just
very
in the
advanced.
room. We're not. I don't want to see. I would prefer you guys not taking trades within the range. I mean, when time and price aligns, as Matt Mickey is clearly demonstrating, then it is within a framework and within a model to take a trade. Creating these windows in these boxes and confidently watching price react to those boxes is a thing. Right? It really, really is a thing. For us, I prefer seeing price reject off of that red box window.
Exactly.
And consolidate slightly, not take that higher fair value gap. That would potentially remain as a breakaway fair value gap. And for me, I'm most interested in creating a narrative. And it means that today's price action, the optimal trades happened before we engaged within class or within our own individual analysis, then I'm fine with that because we're early enough within these sessions.
So you
we're
want
just in the second 90-minute cycle of a 90-minute cycle session where there are opportunistic, high probability trades.
So the way you would align this, if you were to take this trade, because you want to find that displacement that ICT always talks about, and remember, like, so right below this box, this is where I put my sell stop, right? Because I want price to come back down, and I want at least on the 5-minute cycle to get that momentum on my side. So my sell stop would be right below this red box, and if it keeps going up, cool. I didn't get in the trade. I'm not gonna, because of it's still only a 58% probability that this continues to the downside. That's still a very low probability for me, right? So if I were to, like, this was my model where I aligned DR data, time and price together, I wouldn't enter up here. I would give up the points and I'd wait for that displacement here, and I'd put my buy stop or my sell stop like this, and at least get the momentum and displacement into that leg, right? And I could add to with another sell stop with the KM7 model when it comes back in. But I personally would, if I was to take this trade, it would be with a lighter position because, like, but we are below that midnight price, and we are coming up on premium from that midnight price, right? So a daily candle currently looks like this right here, right? So right now, let's see how this next 5-minute candle gets. We're just sim trading right now, like, and plus, you guys got to realize it's the first day of the trading week. You don't have to rush. If your perfect setup's not there,
I prefer patience. I prefer advocating and preaching patience. Captain Matt Mickey is showing you guys the
right
levels that there are within these models.
So our sell stop would have got triggered just now. Our sell stop would have got triggered right now because now we got momentum on our side. Our stop would be very above the 5, right? I'm not saying to take this trade at all because it's still a low probability trade. But if you were to trade just time and price, this is what it would look like, and that's how you would trade it, right? And when I say time and price, I mean off of the DR historical data, right? Remember, we still have a 6 o'clock candle to go, right? And that's a pretty big deal. But that's just for the people who want to trade just pure DrLens data, right? That's how you do it.
Getting comfortable and confident with this idea of data and time and price is an important thing. I would say patiently from a rules standpoint, based off of KM7, the if-then statement would be we would really want to see it play off of the ADR's price. The ADR's DR is within London's range. So we would want to potentially see that 330 fair value gap that was formed. We would want to see if price wants to come and efficiently be delivered to the 330 candle. And then we would like to see it wick and or kiss, I'll say, the DR right above that. That would give us a premium PD array that would play out the 330 candle. That would bring us back to open price. And we wouldn't want to see price enter back into the Asian range. Why our model and the rules within the model are what they are is because look how tight of a backstop that you would have available within the IDR and within closed price that could potentially invalidate that trade plan. So the idea is if you're wrong, you're instantly managing your risk. And when you are taking trades within the range, I'm just going to say it's advanced. There are models, there are folks that are taking trades within the range and are analyzing time and price and basing their trade plan around that idea. The trade model, KM7, our rules would state that we are patiently waiting. Now, we're also analyzing price. So what Captain Matt Mickey is doing is very clearly showing you where and how price is being analyzed to form his trade plan or what could potentially be a trade plan. Collectively, I would like to see these retracement legs up. I wouldn't like to see us leave the London range, right? I wouldn't want to give a confirmation long after we've had this short. I would want to see the if then statements. I would want to see if time and price are not aligned within the data. I would like to see price fill the premium inefficiency in the fair value gap that was formed at 330. And then I would like to see price take the open price of the London range to kiss off of the DR and form or create these retracement values. So we're constantly looking at and running if-then statements algorithmically. So looking at fib levels, structure, narrative, high time frame narrative, levels, DR levels, historical data, these are all extremely powerful. And it makes life as a trader a lot more simple. So, or a lot simpler.
And
go ahead, buddy.
Let's see. Yeah, so like it's okay to just sit on your hands and do absolutely nothing. Right now we know a couple of things, right? We're on the second. We already did the market maker sell model, right? It was right here. And Monday's ODR was consolidation, RDR was manipulation, distribution down, and then we experienced our second distribution down during this ODR cycle, right? So that's how you align ICT with DR, right? It doesn't make sense to be trading this kind of day, right? We might get this trade might work because it's backed by the DR historical data, but from an ICT concept, it's time to sit on your hands and just let this play out, right? This is one of those days where we've already experienced the silver bullet. We missed that, right? You know, like it's okay just to go cut the grass and just study and backtest and build chart books, right? You don't have to be in a trade every ODR, every RDR, you wait, especially if you're trading size, you wouldn't be allowed to take this trade, right? Like my personal rules wouldn't allow me to put real size behind this move, right?
No, it'd be risk on, not risk off.
Like I'd be in a risk off scenario right now. Risk on means I'd be everything's aligned to take the trade, right?
Yeah, risk off. I'm sorry. Thank you.
But that because my risk profile and how I trade, like this is like my intraday trading is only 10% of my portfolio, right? And it's used to hedge the other parts of my portfolio. So this would not be. I'm making money in the equity markets and volatility markets, like everywhere else, right? I don't need to risk this for Biscuit if it's not a high probability trade, right? For you guys, a lot of you guys, this is your only account, right? And once you gain more wealth, you're going to diversify outside of your intraday trading. It doesn't make sense to put all your eggs in the basket of, you know, like the most complex trading style there is, which is anything intraday, right? So like this would not be for me and my personal risk profile, probably wouldn't take this trade. Like remember the other day when I told you guys I came in and historical data, time and price aligned perfectly and everything aligned perfectly? Like that was a risk on scenario and it led to me taking a 13-hour trade, which I traded a lot of size with, right? But like this is the same kind of scenario, but we walked you through how it is different, right? From many aspects, it's the same setup, right? When it comes to historical data, but it's the wrong setup when it came to live price action. So hopefully we didn't confuse you too much. Kid, I am going to go on mute unless you continue on, all right?
Okay, that's cool.
I do have to get ready for work, bro.
Yeah, we're I'm trying to keep these closer to a 90-minute cycle, especially on days like today, right? So if you guys want to flip back to my screen, feel free. The trade plan or the idea would be potentially to look something like what I've drawn out on the pathway.
So you're saying it's going to go test that midnight price again, right?
I mean, what I'd like to do is see it. No, I'm not trying to fade you at all. I'm saying based off of the rules within the model, what I'd like to see it do is mitigate the fair value in the premium.
And that aligns you with the game range. Yeah, so that's a smart trade because it aligns you with the Asian IDR and
this would fall within our model, which would fall within our rule set of rules of engagement. This is what I would want to see to engage with price. Otherwise, it's all narrative forming. And within creating a narrative and forming a narrative, if it were to play out, I would take a very tight stop off of the IDR, off of the close price here, off of the DR price right here. So I've got multiple backstops within this trade plan that are very tight. And for me, within managing risk, that what Matt Mickey outlined for me is narrative forming towards what would be a high probable trade. And if his narrative is correct, then this is a trade that doesn't happen, and I sit on my hands.
Exactly.
The only way I would be interested in this price action based off of what's happened, and we're analyzing NQ, is I'm looking at how price was projected, how it extended past that projection, and then how I took that projection and I projected it upwards.
And that's what you said on the NQ is exactly what's playing out on the ES right now, right? So, and don't ever think you're fading me, right? We both
no. I think you did a phenomenal job of explaining to folks what is time and price. And very much I want to say level 2 within the semesters of learning. Today is a master class on what is to come, what will be back tested, and will be advanced levels of our modelistic approach. But within one single model, with one specific rule set, our rule set is we take trades off the DR. We don't take trades within the range. If you're taking a trade within the range, then you're opening up your risk. Because you're opening up your risk because you have a higher stop loss than what I'm teaching you. I'm teaching you a stop loss and why you would take a trade from here with less risk, right? This can be 100% correct. It totally can be correct. And for me, again, that goes back to narrative. And with where we're at in relationship to this range, with where we're at kissing off of the 50% line, right here, this very easily could follow and work its way towards Captain Matt Mickey's plan and consolidate a little bit within this range and create more of a higher resistance liquidity run on its distribution downward. Or it might not even fulfill more past this extension and just simply chop and then go for a deeper retrace based off of the data at a latter part of the session. So
exactly,
this is the if-then statements within the model that I would like to see, in which I would want to engage with price. Otherwise, we wait, and I would not engage in price. And for me, it would be that simple within the model of what we would potentially look for.
And so right now, what we can see is the ES is doing an SMT with the NQ, right? What you just outlined happened on the ES, right? Is this the ES or is this? Yeah, there we go.
Yeah, here's the ES right here.
Yeah, so we did that. Right now, we're at that point that Kitt drew out on the NQ. We're already at that point on the ES, right? So that shows that there could be a SMT happening at some level between the two. But any questions? I feel left behind. I can't catch up. Death rolls. You just came in the room last week, right? You don't know ICT and you don't know DR, right? So that means you're in the education phase, right? So you need to take diligent notes, and then you need to start shifting. You don't need to know all this, right? Just like take DrLens and start testing that first and foremost, right? And then move into the KM7 and start testing that, right? We don't expect you guys to be proficient at any of this just yet. You guys just came in the room. You're in this room for a reason. It means that you probably aren't consistent with trading and you need help, right? So stick with the model that Kitt outlines, align lens data with it, and that's all you need.